to you most of the time. So today we're going to be talking about something very interesting. And this is really not necessarily TradeShield specific, but upskilling you in if you are within the credit team, if you are within the sales team, to understand what your team is experiencing, what processes they need to follow, and of course, just understanding the industry that we're in. When I say industry, I mean around credit and why people make certain decisions. What are they leveraging off? So if you're in the sales team, why did somebody say no to my credit application? What factors have gone into it? And what rules should we be following when it comes to offering business on credit? And I know that we're very excited, Martin. I know you are excited about this as well, having had many years. Just, you look very young, but having many years of experience in this field and understanding that, what credit was back in the day to where we currently are is very, very different. There's a lot of things that we can't do that we used to be able to do. For example, traditional trade references, for example, where before you could phone up somebody and say, how is this person trading with you? And they would give you an honest answer. Whereas today, there's every excuse as to why someone can't give you that information, due to POPI or due to, just worry that you might upset somebody. And so trade references really were one of the biggest things that we used to rely on, and we aren't able to do so anymore. And or, people operate from home. They use cell phone numbers, which are unverified, as opposed to, going to the yellow pages, and more than just for standing on to grab something that you couldn't reach from the top of the table. So myself included, I'm still that person. Do you want to give us, Martin, a quick introduction as to, what it was like and things that you used to rely on, um, you know, before the digital age, let's call it that?
Amy, it was a challenge in those days, but also saying that the margins in those days were humongous. The companies gave 60-day terms, gave 90-day terms. A credit agreement was you and I shaking hands, and it was done. And I'll buy from you, and I'll pay you. That's how things happened. And the credit control team usually consists of one or two people that sat in some dark office in the back of the building, not really a focus of the business. But since that focus shifted, and cash flow has become such a critical part of the business, and parts of the business like procurement that drives down your margin because they want things cheaper from you because they can get it cheaper somewhere else. And that whole scenario created a whole different element of way we do credit management. And then, of course, came all these other things, that there's no more bank codes, there are no more trade references, there are no more this. And all of this put more stresses on the credit control team. So now they've got a target in which they got to collect, they've got to bring in the money in a certain time, they've got to keep the DSOs down, they've got to keep the overdues in line, and they've got to process the new credit applications within a timeline, and all of these things. And
Yeah.
a year gone by, they almost hit the middle 2 weeks of the month was the quiet time in credit control. Gone are those days. The quiet time in credit control now is between 2 o'clock and 3 o'clock in the morning. That's the quiet time that these guys have now. Because the rest of the time, there is huge pressures on this team. Now, what we're going to do now might be a lot of repetition for some of the credit controllers. But you know what? I always listen when someone talk. Why? Because I might just learn something new, or something that might have changed, or something I never knew in the past, and maybe now I've got some clarity on it. So, if we repeat something for you, just listen, add value, make some good comments, support Amy while she's training, but take part in the conversation. And if you have questions, don't hesitate, pop them in the chat, pop them in the questions and answers session, and we will answer you, if not in the right now, in the course of the day. And if you don't want to put it there, but you feel shy about the question you're going to ask, you are more than welcome to ask the question afterwards. But listen to Martin. Bigger is the fool that never asked a question than that one that asked it and got the answer within 5 minutes.
Absolutely. Absolutely. Okay, so let's jump straight into it because we do have quite a lot we want to cover today. So what we're going to be looking at is the fundamentals of credit management. And part of that, you'll see that we're starting to talk about what is the introduction of credit, what is credit, where did it come from, and what do we do? What are the fundamentals of credit? The key terms that you will hear in the credit industry, the 5 C's of credit, or you can call them the rules of credit. What are different terms and how are they calculated? And then how does a debtor age? And what is an aging file? So that's what we're going to cover today. So let's go on to the next section. So what is credit? So credit in the B2B space, and we're referring to B2B, and let's explain what that is. Business to business, not individual to individual or consumer to consumer. We're specifically talking about when one business deals with another business. Obviously, there are consumer-related questions around credit. For example, if you had a personal loan, if you had a bank account, if you had a credit account, and that would be you in your personal capacity. But what we're referring to in this particular instance is when one business sells goods and products on terms to another business, allowing them to purchase whatever it is they need and pay you at a later date. Okay. This is very common in lots of different industries. And this could either be in a service-related industry. So you may sell a service, for example, if you do data security, for example. So you're selling a service, or if you're in the tire industry and you're selling an actual physical, tangible good. So that is what we are referring to when we say that you allow someone to take the product now and pay later. So here you can see that it's goods and services that are sold and rendered on terms. Why is this important? So this is number one. Why do we do this? This is, one of those key problems to say, well, okay, that's very nice, but why? So here we're allowing businesses to be able to grow their own companies by being able to purchase the goods, resell those goods, and then make money back, and then obviously pay you, hopefully making a profit. But we're helping to grow the economy. We're helping to grow other businesses by giving them the opportunity to have a product, make a sale, and then pay you back later. So we're really contributing more than just, did I grow my business, but actually, did I help grow the full economy within the country or countries, or, if you go cross-border internationally as well, how are we contributing towards those countries as well? So credit is of very vital importance, and selling on credit is a massive help to other businesses as well as to your business. Nothing for nothing. You also make money by giving and or selling your product. Okay. So as I said here, there are different types of credit. So we have something called revolving credit. These are more on the consumer side. For example, credit cards, lines of credit, credit with different institutions, like if you have a credit account at Woolworths or Truworths or one of those areas, and or installment credits like personal loans or auto loans for your cars, your mortgages, your B2B credit. That all lives in the installment credit. So we've got revolving and we've got installment. Okay. Then we've got our credit terms. So what are credit terms? So they usually work on a rolling scale. Every business may have different terms. For example, you may have 3-day terms, meaning that somebody needs to pay you within 3 days. And we'll discuss at a later stage whether or not it's 3 days from the invoice that you send or 3 days from the end of the month when we send a statement. Okay. So there are multiple different types of terms. It could be 3 days, 7 days, 30 days, 90 days, 60 days, whatever it is. These are the different areas that you would normally allow the person to pay you off over that period of time. That's what we refer to as a credit term. How long is it going to take that person? How long do you expect that person to take to pay you over a period of time? Okay. Then we also have something called discounts and early payment settlements. So you do have a lot of suppliers who say, if you settle before your terms are up, we'll give you an additional discount. So if you have 30-day terms and you pay before the 30-day terms is up, then we'll give you a settlement discount. And every company will be different. Maybe it's 2% if you pay within 10 days of receiving your invoice, or 1%, or whatever it is. It's an incentive to say to your customer, I will give you a discount if you pay earlier than you are expected. Okay, so early settlement discounts. And again, this is at the discretion of the company. It doesn't have to be there. It's just something that you could do to encourage early payment. Now, why would we want early payment? Of course, it affects our bottom line. It affects our cash flow within our own business so that we can use that money either to invest it and grow our own business using interest. We could choose to, buy more product for ourselves. And it's always good to have cash on hand because you just never know where you're going to go. Cash is king. I know diamonds are for queens, but cash is king. And that is why we would want to make sure that we have cash in the bank. Okay. Then we've got our accounts receivable management. So that's you and or me. We are the credit controllers. We are the credit team. Could be a credit manager, could be a financial manager. And we're enabling us to be able to give the credit in a responsible way. So that is what the accounts receivable management team is there for, is to make sure that we're giving credit, but we're also giving it responsibly. Responsible because at the end of the day, we have an obligation to our own company to make sure that we're still here next month. So it's all good and well to give you our product, but if we don't lend responsibly, then obviously our business is going to suffer and we're going to close down. Okay. So that is the accounts receivables team and the impact and the role that we have on the economy. Okay. Then, of course, part of that process is the credit worthiness assessment. So as I said earlier, the role of the team is to make sure we lend responsibly. And the credit worthiness assessment goes and looks at different aspects like credit checks and or credit limits that we need to do. So we go and say, let's go and check on this business. Who are they? Where do they come from? What do they do? What information can we get on this customer? And we want to go and say, what can our business handle in terms of credit limits? In terms of, if we offer them 30 days, is that something that we can actually do? And is that something they can do? Because you often run into a situation where somebody has a very large company and they are unable to, in their treasury process, manage to pay you within the terms you have provided them. And if you think about it, you can say, if I were to physically have a piece of paper and I was running from team to get approval before it gets to that team, the treasury team, to actually release the payment, what does that look like? So if the company is unable to make 30 days and your business is unable to provide longer terms, then you need to negotiate on pricing. You need to negotiate on, making sure that your profit margins are calculated correctly in order to safeguard both parties. So that is what credit is all about and why we need to think about it in a holistic environment to say, if I'm thinking about all these things, that I have to think about me, and I also have to think about the economy, and I also have to think about the company that I'm going to help. But very important is making sure that we still are in business and trading and making a profit so that we can create jobs, that we can, contribute in other ways towards the economy as well. So no pressure, big job, where you directly are impacting, the people who live around you and the areas around you. Martin, is there something you would like to add to that?
Amy, not much, but one thing that is critical, and you've just touched on it, there's the micro and then there's the macro. The micro is, how does it affect me and where I am and the company that I work for? The macro is how what I do and decide affect the companies that I trade with and how they pay me, because that again will affect how I pay. And that's how that macro now becomes bigger. Because if you don't get paid, you can't pay. If you can't pay, they can't pay. And all of a sudden, this whole thing snowballs. That's why it is such a huge disaster when one of these big public companies go. Why? Because they buy from someone and they sell to someone. And all of these people are going to be affected because now all of a sudden you can't get the product because they used to supply it, and the people that they used to buy from. Just imagine if the platinum mines close in Rustenburg. What's going to happen to Rustenburg? That's the economical impact that we're talking about, because it's going to affect everything, because everything in Rustenburg evolves around the platinum mines.
Absolutely. And the subsidiary like towns next to it, for example, if you look at Brits, then you know, Brits was built on that as well, and next to Rustenburg and the smelting factories, and you know, and then the businesses around those businesses, like the restaurants and you know the garages, and all of it affects every single person within that area when you know, a particular industry doesn't you know, won't be able to continue. So absolutely very vital and very important. Okay, so let's talk about a practical example. So how does this fit into my life? Where does this fit into my life? So here you can see we're talking about a wholesaler supplier. So when we refer to supplier, meaning your customers go, you are the supplier, you supplying somebody with some products or services. Okay, and it says here, you extend credit to a small business. This supplier, that's you, offers 30-day terms, allowing the small business to purchase supplies and pay within 30 days. Before extending credit, the supplier performs a credit check and sets a credit limit based on the small business's financial health. Now, that's very, very important, because it's not only about how much can we give, it's about how much can a person actually afford to pay me. Okay, and the credit limit should be based on that. The supplier sends an invoice with clear payment terms and follows up with payment if it is overdue. This arrangement can help the business to manage its cash flow while maintaining a steady supply of office materials. So this is saying that if you were an office material supplier, and in order for you to trade and do business, you need to have stock. But in order to have stock, you need to have money. So we're allowing that cycle to continue. So in conclusion, it says that the credit in the B2B space is a vital component of business operations in enabling companies to manage cash flow, build customer relationships, and of course, drive growth. I'm sure we all speak about driving growth. I know we do here as well. You know, very important, and something we can mention now is that we are going towards one of our key company goals is to have 10% of the South Africa GDP coming through the TradeShield platform. We're currently at, I think, 6.5%, Martin, of GDP that comes through TradeShield, and we're hoping to strive for 10% by the end of our next financial year end, contributing towards the economy and helping to see where can we help customers grow. So very, very important is driving growth. And of course, and add a little bit of TradeShield in here, is driving growth with the right customer. So that's very important, okay? And then effective credit management practices, including thorough credit assessments, diligent account receivable management, and of course, essential to mitigate risks and ensure financial stability of our business, okay? So here you can see, why do we do this? So wonderful, we've spoken about our impact, but also on what does it mean for us? So obviously we can increase our sales. We can have customer loyalty. If we provide a good service, the customer is going to repeatedly buy from you. And as their business grows, your business grows. Competitive advantage. So some customers who may not offer 30 or 60 or 90-day terms, or even terms at all, gives you a competitive advantage over other customers. Market expansion, so meaning that you know, the more you grow, the more of the market you will envelop, potentially maybe even buying your competitors and growing your business from there. And of course, we spoke about this earlier, is cash flow management. So, you know, making sure that our credit sales can help manage cash flow by ensuring a steady stream of future purchases and payments. I'm going to pause there for questions. Does anyone have a question on a practical example?
No,
There
not
is
at this
one.
session.
Okay, perfect. So here you can see we're talking about a few different terms that are brought up within the credit industry. So we're talking about these things because, you know, somebody might mention it, this, then you're going, I don't know what you're talking about. So first and foremost, we've spoken about credit limits, and this is the maximum amount of credit extended to a customer. So the credit limit is how much are we going to give to this customer, okay? Then we've got our payment terms. How long are we going to allow the customer to take to pay us back? So you can see that underneath it says conditions which payments are due, including any discounts or early payments, okay, as well as penalties. So I use the word penalties because some companies are not actually able or allowed to charge interest because you are not a registered credit facility. So some customers don't even like the word credit, they call it purchasing facility. And so, you know, there could be penalties for late payments. The credit policy, of which I know this is Martin's absolute pride and joy. This gives us the guidelines of what do we do and when. What does our company allow us to do? Where can we negotiate? what do we do if something has happened and we need to escalate it? Where do we escalate it to? How do we escalate it? And what processes do we need to follow? So credit policies are unique to every business and absolutely vital for our credit team to know when and where to go. Collections. So of course, this is part of the credit team's function, is making sure that we get the payments from the customers, almost like being a little bit of a mommy. We send an invoice, we follow up, and of course, we know our customers. Very, very important to say, I know who you are, I know your processes, and we have built that relationship. So collections is a vital part of the business, because I can give you my stock, but if I don't get paid, again, I'm going to be sitting with a cash flow issue. Okay. Credit insurance. So credit insurance helps protect us. And this is, we call it almost like a grudge purchase, like life insurance. We never actually want to use it, but it's always good to have, because you just never know if someone is going to default on payment, and that payment is a massive impact on our business. We're going to want to have some sort of fallback plan that it doesn't close us down. A lot of businesses have, a large portion of their income comes from their top 10 or top 20 customers. And should one of those customers happen to go out of business or default on payment, it could have a massive impact on our business. And therefore, having credit insurance as a fallback plan is something that we may want to consider. And even in this instance, it may be that you don't insure your full book, you only insure a partial part of your book, but you have that protection should something happen. And we won't go into too much detail about how credit insurance works, but it is something that, you need to understand and know about. Then we've got the word risk management, and this is something that us at TradeShield, we love. This is the core of our business, is procedures for assessing and mitigating risk. So making sure that we don't need to rely on that credit insurance, because we're constantly on the pulse. We know if something has happened to this business in terms of business rescue, liquidation, or anything like that. We know if there's judgments. We know if they're paying slowly. We know if directors have, been changed, and that could impact the business. We are aware, because we're constantly checking what's going on. And like Martin said, if it's area specific, we're aware, we're watching the news, because we know that this person is vital to our company. And if the factory that we deal with in Rustenburg is going to close down, we need to start mitigating that risk before it takes place. So very, very important is risk management, and this is something we do on a constant basis. DSOs, or days sales outstanding, DSOs. This is the amount that the average number of days it takes for a company to collect payment. Okay. Now, DSOs is something that's very important, and it's done on a invoice level to say how many days has this invoice been outstanding, so days outstanding, and we measure it as a company to say how long does it take a debtor in general to pay us. And each company and each industry should have a standard. So for example, if you are in a service industry, your DSO should not be more than like 32 to 35 days. Am I correct, Martin, in terms of days outstanding?
That's correct, Amy. Why? Because there's nothing that you can go and fetch back if they don't pay you. You've already rendered the service, and the money has now been laid out. Now you've got to get that money back in quickly so that you can continue rendering service and pay your staff. Let's use an accounting company, for instance, as an example. So if you're an accounting firm rendering an accounting service, you've got staff that does that work for you. So now you've got to continue to pay the staff, and if you don't get paid, you can't pay them. Then what's going to happen to your business? But in most businesses, the margins are so small that you got to collect that money as quick as possible. Otherwise, your margin is eroded and you are starting to giving your product away for free. And that's why the DSO is so important, and how you measure how quickly your debtors pay you.
Absolutely. And, we can touch on this at a later stage in terms of, how much and how this is, how a credit limit and a selling price is calculated, which can affect, the more somebody or the longer somebody takes to pay you, the more it eats into your profits, because of course you can't eat into your daily expenses, because you cannot pay your rent, you cannot pay your employees. So it does eat into your profit, and at some point it will then your liabilities will be greater than your assets, in which case your business will close down. Okay. So very important to track that. Then we've got our accounts receivable team. So this is the entire team that we refer to, and this could consist of, and everybody's business is different. It could be credit controllers, credit managers, CFOs, financial managers. All of this fits into the accounts receivable area. And this is when money is owed to a company by a customer for goods and services that are sold. And that is the team that is responsible for making sure that the entire process is followed correctly. We've got credit worthiness. So this is the assessment of a debtor's ability to meet their financial obligations. So this is not just looking at statutory information. So are they in business? Who are their directors? Where are they located? But also how much money can they afford? Let's look at everything that we would need to make a decision around somebody's credit worthiness. So something we say in TradeShield is, yes, how much can you afford? But also, how do you behave? What is that process together in order for us to decide your credit worthiness? Okay, so those are the different terms. And now we get into the 5 C's of credit. And this is something that gives us the idea of what we should base our decisions on in terms of what do we follow. So you'll see that I do have 6 because I slipped one in there specifically for Martin, because it is an extremely important one. It doesn't start with a C, but I'm sure we could probably find a different word for it. But let's start with the first one. So the first one that we have is the character. So the character is looking at the credit history and the reputation of this customer. Who are we getting into bed with? Who are you? Who have you dealt with before? Who are your directors? What do they look like? So we want to understand who is it that we are going to be getting into a relationship with, okay? So very important. The next one is capacity, and I'm going quickly because we're going to go through all of them individually. Capacity, which is the ability to repay you, okay? You've got the capital, which is the financial resources and assets that this person might have. So if you can't pay, what can we do after that? Collateral, what security do we get for to safeguard us and our services and our products? Conditions, so what are the terms and conditions that we are going to agree to? And then this one is for you, Martin, it's your gut. If your gut tells you that something is wrong, it's most probably wrong. And we very much say that if you don't feel right about it, please go ahead and, go and do some additional research. Go and, trust your gut. Very important. You can follow all these 5 C's, but if you feel that something is not right, trust your gut. Okay, so let's go into the depth of it. Yes, Martin.
While you're talking about character, Jessica, the one thing that pops up, there's one question that we need to ask ourselves these days. And that's very important, is why do you want to buy my product? What are you going to do with my product? Because that's where a lot of people get caught. They just hear this client's there, they want to buy for an X amount of money, and they don't understand that this could be a fraudulent transaction. We've spoken about it so many times, and we're probably going to do it later in the stage. But think about it, and that's the KYC. Know your client. Understand who they are and what are they doing and why do they want your product.
Absolutely. And also, if it doesn't make sense, even if you'd like them to buy your product. So let's say, for example, I'm in the tire industry and suddenly Checkers wants to come and buy from me. Wonderful. That's amazing. But what are they going to do with my product? And so you have to understand, like, does it actually make sense? And usually if it doesn't, it's because there's something wrong. It could be fraudulent. It could be a mistake, whatever. Just trust your gut. But let's look about the different areas within credit. The first thing we want to look at is their credit history. So how do we do this? Of course, we go and get a credit report. And all through TradeShield, we give you this credit report to say, what does this customer look like on paper? Is there something about this debtor that we want to know? For example, do they have judgments already? How many directors do they have? How old are those directors? We want to know, do those directors have other businesses? What do those other businesses look like? Because, how one person runs one type of business, they're sure to carry that over into their other businesses as well. So we want to go and see what's their credit history. References. Who do they trade with? And you can ask these questions. Who are the other people that you trade with? Where do you have other accounts? Let's see that this is actually a valid company. So we're making sure that we're getting our references, we're phoning people. It's okay to ask these questions. And of course, from TradeShield side of things, we will tell you the payment profile information. So how do they trade with other suppliers? Employment history, we want to go and have a look and see, is this a stable company? Maybe you want to go and research on all the different platforms to see, what do people say about working at this company? Things like Glassdoor, for example. What do they say about working for this company? Do they say they're happy? Are they complaining? Does it seem like there's something not right? And then, of course, personal background. We want to make sure that this person has integrity, that this person is reliable and overall trustworthy, to make sure that we can give them our product. Neil has a comment.
Yes, thanks, Amy. So I just wanted to make a comment on how I think everyone should be currently framing this in their mind in terms of TradeShield scoring. So if you look at credit history, right, and then you look at references, right there, you're looking at payment score and default score. If you look at employment history, you look at personal background, those are default score elements. So your references, your default score elements are all considered there, and your credit history is your payment score. So just keep tying it back into what TradeShield does for you, and then you can see how these 5 Cs of credit tie into the system. That's it.
Thank you, Neil. Okay, so here you can see it says that character helps the creditor gauge the likelihood that the debtor will honor their financial commitments, and it's essential to be able to trust that person. And I like to use this example of myself. Some of us we've met before, some of us we've met, seen each other online many times, but you don't know me. So if I came to say, can I please just have R1,000,000? Just, because I'm nice, and you're going to be like, sure, absolutely, here you go. Amazing. Which is absolutely insane. If you were to go to the bank and say, can I have R1,000,000, they're going to ask for blood samples, and your children is put up as collateral. And, and I have super cute kids, so I can see why they would want that. But at the end of the day, you're not going to just give it to anyone willy-nilly. You're going to make sure that you are checking your checks and balances and who you are about to get into bed with. Okay, so the next one is capacity. So now we know you're a lovely person. We really like you. You seem wonderful. Now it comes down to, but how much can you afford, Amy? You're asking for R1,000,000, but you don't even come close to being able to pay me that back, So the first one is the income. How much money or turnover does this customer have? How much can they afford? So you can ask me for R1,000,000, but your entire year, you don't make R1,000,000. So how are you going to pay me back? Okay, so first and foremost is how much money comes into your account. The next is, what is your debt to income ratio? And this should be on your financials to say, how much debt do you have? So if you've got, a large amount of loans, if you've got a large amount of outstanding property loans that you've got, or bonds, if you want to call them, if you've got a large amount of vehicles that you're paying off over terms, this is your debt to income ratio as well. So what's your assets doing? What's your liabilities doing in comparison to your income? Martin, do you want to elaborate on the ratios as well?
Yes, I mean, if your debt to income ratio is out of sync, it means you're trading in an insolvent capacity.
Right.
And that is where what you said just now, when we determine what you can afford, what is your income and how much of that is disposable, how much of that can you use to buy product with. And if there's nothing that you can dispose or nothing that you can use, it means your debt to income ratio is out of sync. It means that you owe more money, or you've got far too much debt already, and you now not can service that debt. And that's why I also say just now, know your client, know what they want to do with your product. Where have they been buying it before? Why all of a sudden do they want to buy from you? Because this might be out of sync, and they now in a situation that they're going to do. There's a nice word for it in credit. They call it kite flying. They fly between one supplier to the next. They steal from Peter to pay Paul, and then they steal from Paul to pay Peter. That's why you need to know this information. We're just snipping it and telling you a little bit about it, because to go into depth, we can talk for an hour about it.
Absolutely. Absolutely. Then again, we speak about employment stability. So how long have they been in business? How long has the directors been directors? You know, if they have a constant churn, if they're constantly changing financial institutions in terms of like their auditors, these are things we want to make sure that are stable. Okay. And then of course financial obligations. What else are they paying for? Meaning that it's going to allocate payments elsewhere, and then how much is left for us. So we often talk about this in terms of, you know, we talk about the turnover and the turnover ratio and the maximum spend that somebody can spend with you. That's what we're referring to here, is how much of their pie belongs to you. Hopefully it was Apple, but how much of the pie belongs to the spend they can have with your company. Okay. Then we've got capital. So we want to understand what assets does this customer have. So whether it's cash on hand, whether it's property, whether it is, you know, hopefully not depreciating assets, but assets nonetheless. We want to make sure that what do they have in terms of assets, and that could be in terms of, as I said, cash on hand. It could be property or tangible goods. It could also be stock on hand. So that is also an asset. How much stock do you have in your warehouse? And that is considered an asset as well. What's the net worth? So overall value of the debtor's assets minus their liabilities. So as Martin mentioned earlier, we want to make sure that their liabilities don't exceed their assets, meaning that your company is actually going to be, you know, in business rescue or liquidation. Usually liquidation when your liabilities exceed your assets. Okay. Equity, so the amount of money that the debtor has in their personal invested into this venture. So how much skin in the game do they have? Let's put it that way, to make sure that even though the directors do not have personal liability, depending on how the company was formed. So if you were a CC, that's one thing. But if you're a PTY, how much shares does each director have in the business? So if it went down, what would be their loss? You know, so we want to make sure that we understand that as well. So how much equity do they have? And of course, liquidity. If they needed to get money today, how can they do that? How liquid is their business? So the ease with which a debtor's assets can be converted into cash. Very important to say, like, you know, if you needed to do, what would we do? For example, if we had assets of stock on hand, how quick would it be for us to sell that to get cash, to pay, make sure that we're paying? Does anyone have a question with regards to assets that we're mentioning now, or anything that we've already covered in the previous few slides?
Quick one, Ames. Will factorial discounting fit into the asset side as capital generation?
So it wouldn't fit into assets, but it would fit into liquidity. So let's say, for example, you were using a factoring or invoice discounting company. You could then sell your invoices and get cash. So it would fit into the liquidity portion as well, very much so. But that is if your company is actually working with a factoring house or an invoice discounting house. But yes, that is a way to get cash quickly. But again, they also have rules and regulations on which invoices they're going to buy and how much they're going to pay you for it.
Perfect.
Okay, so then let's move on to collateral. So collateral, we've got 4 different areas within collateral. The first is the type of asset. So it's all good and well. As I said earlier, you may have depreciating assets like a vehicle, and or you know, what's the word I'm looking for? When it appreciates, that's the word I'm looking for, an appreciating asset versus a depreciating asset. So both of them are assets, but for example, an appreciating asset would be a house, for example, that's fully paid for, and maybe you're going to rent it out, and you're going to, you know, if you were to sell it, you would sell it for more than what you paid for, versus a depreciating asset like a vehicle where the value decreases over time. At some point it reaches, let's call it a pinnacle point where it stops depreciating, but the value will be a lot less than what you paid. But it is still a commodity. You can still sell it. You can still get some money for it. So here we're going to be talking about common forms of collateral, including real estate. So we spoke about that. Vehicles, equipment. So let's say, for example, you had trucks in your company, or you had big I don't know, smelting factory equipment, and this could all be sold off. Stock that you could have, or if you were to sell portions of your business as well to make money. So, and or if your a debtor's ledger that is actually healthy, that could be ceded to a bank or to somebody else, as well as guarantees or cross-company guarantees. So if you were part of a group and the holding company said, we will take responsibility for any debt that takes place in your business, that definitely does help with your types of assets. Okay. Then we've got the value, so the market value of the asset. So this is important because if I say, oh, I've got a house and I paid 3 million rand, but now that area is depreciated massively and it's now become a jungle with roaming lions, potentially that asset isn't actually worth what you feel that it is. So we want to know what is the actual market value of the asset, which is easily obtained from the government within that area. So, for example, if you live in Germiston, it would be Ekurhuleni. If you live in Johannesburg, it would be the city of Johannesburg, who would give you the market value of that asset. And of course, we can always go to property management companies and ask them as well what things within that area are selling for at this present moment in time as well. So it's not only about what we paid, but what it's worth today. And it could be more. Maybe it's a good thing you bought a rubbish house in a great area. That great area has just become even better, and now that asset is worth 10 times more than what you paid. Okay, so that's the value. And of course, ownership. So the debtor must have a clear ownership of the asset, and this can be very easily proved. There's lots of documentation to say, I own this house, as opposed to me just saying, I own that one on the hill, that one is mine. I need to be able to say, these are the documents, here is the ownership documents that you would have. So we want to make sure that we cross our T's and dot our I's. And then, of course, conditions. So the physical state and the usability of that asset. So as I said before, you could have a really rubbish house in a wonderful area, but at the end of the day, the house is dilapidated, the roof is falling down. So we want to make sure that the condition of whatever it is that we're going to buy from them or use as collateral actually has a value. I could buy a smelting machine from you, but if that smelting machine itself is melted, then it doesn't actually have any value.
Or it is bonded, or it is still under hire purchase. You're talking about movable assets. So machinery must still be under a hire purchase from a bank. Although it's worth something, it's worth nothing to you. So if they've given you an material bond is over movable assets, where a bond is over a non-movable asset like a property. So material bond has been given to you for movable assets, but those movable assets, the trucks, the machinery, and all of that is still under hire purchase with the bank. It's an asset with no actual value to you. Although it's valuable, it's got no value to you. The same with the property. They say we'll give you a second bond, but if the first bond is to some bank and it is bonded to the hilt with the bank, then what is that going to be worth to you? Nothing. Call it a covering bond.
Yeah. And so also, if you've ceded your debtors book already to somebody else, then where in the queue are we? If you've signed personal surety, but you've signed personal surety in multiple other places, where in that process are we? So should something happen, we need to understand, where do we claim, first of all, and where in the queue are we? If we're right at the end, are we ever going to make back the money that we gave? Most probably not. So that's also very important to understand. If somebody has given over or has a second bond, of course, the banks are always going to be first, and any outstanding values will be paid to the bank, and then it will then be distributed thereafter. And again, depending on where you are and what has been signed. So very important to understand it. And the only way to know this is to ask the questions. Don't be afraid to ask the questions. It is your money. It is your product. It is your service. You have a right to ask those questions. Okay, so then the last one is the conditions. So again, everything that we've spoken about may add up perfectly, but there are certain things that we need to take into consideration. So first of all is the economic environment. Okay, so we touched on this earlier, which is the overall state of the economy, including factors like inflation, interest rates, strikes, and civil unrest. If we're looking at countries within the African continent, for example, I'm sure that this brings up to mind a certain amount of or different places where we feel that our money may not be worth as much as it is in those environments, and getting our money back because of the economic environment may also prove very difficult. But we also see the value in trading cross-border because we're helping to grow those companies' economy and eventually hopefully help. But we also have to understand that if the country is in the middle of a war, that's not something we have control over, unfortunately. Okay. Then we've got industry trends as well. So specific conditions within a debtor's industry that may impact their market. So for example, if you are trading in a company that, the gold industry, for example, and the gold industry is in a very difficult position right now, you have to understand that. You should say, like, maybe because of all the illegal mining that's taking place, this is affecting our margins, this is affecting our customers. I'm just giving an example, potentially that might not be real, but just an idea of what industry trends could look like. Okay. Then we've also got the purpose of the loan. So the reason for the debt and how it aligns to the debtor's industry. So for example, if you sell like one of those windmill, those big turbine windmills, and you sell the crane that goes, and we do have a customer that does this, I know that, I don't know if you're on the call, but so you sell that crane, and you sell that crane technically on credit because it's worth billions of rands or millions of rands, and you get that person to pay you off. You understand that it's a huge cost to your business, but it is only one product. So maybe they took a loan, and it's a big loan, and it's for that one thing. So it does understand the purpose of why you did something. So that's very important. Okay. And then, of course, the terms. We love this one. The terms of the loan. So what specific agreement was included? What interest rates? What repayments have you been given? And that will make a difference as well. So, for example, if you're looking at a car and you're saying, okay, I can only afford 5,000 Rand a month. That's what I can afford on a car. Therefore, I can buy a car that's worth X amount of money. But am I going to take a balloon payment, or I'm not going to take a balloon payment? And then, of course, what effect is that going to have? So what are the loan terms? And let's understand what the terms and conditions are as well. So it's a 5-year term with a balloon payment. I know that on the 6th year, I'm now going to have to either pay that money cash or refinance that money, for example. So that would also be the loan terms. And it can say that the conditions help the creditor, which is you, to assess the risk associated with external factors, things that are not within your control, that could influence the ability of the person to pay you back, or in this case, the debtor. Okay. Any questions on the 5 C's of credit and or how they fit into our business and why they are so incredibly important? So far, not. Okay, perfect. So now we get to the terms of an invoice. So we, as I said, mentioned earlier, there's 2 different ways we can offer somebody credit. One is 30 days or terms from an invoice, and the other one is terms from statement. So what's the difference between the 2? Terms from an invoice means that you buy something from me today and I give you an invoice today. Now you have 30 days, let's say the terms are 30 days. You now have 30 days from today to pay my invoice. So it's when I send it to you. So here you can see we've got the invoice date, the payment terms, and then the due date. So it would be due exactly 30 days from today. So today is the 3rd of March. It would therefore be due on, I don't know how many days are in March, probably the 2nd of April. Okay, I think there's 31 days. I can't remember 30 or 31 days. I can use my knuckles, but we'll do it just now. And you can see that it is not based on the end or beginning of the month. It is based on the actual date that the invoice was sent to you. And it also means that you pay every time you buy from me, you have to pay. And so that is what we mean by due from invoice example. So terms from invoice. Does anyone have a question about how that looks?
I just want to add something, Amy.
Yes.
Because we're talking 2 different payment terms. One is from date of invoice and
one is date of statement. Yeah, Martin, you froze for a second. There you go.
System can't cater. And your system doesn't cater for the term.
Yeah.
So because an invoice from date of invoice means your invoice rolls into the next aging bucket when it reaches that date of due. Then it goes to the next aging bucket. Whereas if it's from date of statement, it rolls once a month. Date of invoice, it can roll any time in the month whenever those invoices become due. So please make sure that whatever you quote your term to be on your invoice is in line with what your ERP system caters for.
Absolutely. And then obviously our next example, oops, it's going the wrong way. Our next example would be terms from statement. So when we say terms from statement, means that you have multiple purchases during a month. And at the end of the month, we send you a statement to say, this is how much you owe. And now you have 30 days from this statement to then actually pay me. Now, the difference between the two is the invoice says from 30 days from today, meaning that I'm going to count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 until we get to 30, and then I'm due. This one says you may have bought on the 1st of the month of March, but this invoice, I'm only going to invoice you at the end of the month. Therefore, it's also only due at the end of the following month, meaning that there's actually, if I were to count the days, 60 days between those invoices. So very important to say that I may buy from you today, but it's actually only going to be paid in 60 days. So I have to take into consideration, can I afford not having that money in my bank account? Can I wait for that payment to come in on those terms? And is that going to affect my profit? Because obviously in those 60 days, you have set costs. You have to pay rent every month. You have to pay salaries every month. So these are set costs every 30 days that your business experiences, but you're only going to be paid on 60 days. So very important to understand what's the difference between statement and what's the difference between invoice. And with statement, there can be multiple invoices up until that point and not just one, maybe just one. It can vary. And we have to understand that the statement date, the payment terms, and the due date can calculate to a solid 60 days if we've given 30-day terms. If we've given 60-day terms, we're actually looking at 120 days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, like that. 120 days in which that money will not be in our account. Okay, so very important to understand the difference between statement and invoice. Does anyone have a question around the difference between the two? And again, this is set out by your company's credit policy to say, what can we afford? Somebody went and worked out how much margin do we need to have? What are our expenses? What do we need to make sure that we're covering in order to still turn a profit? So that's very, very important. We want to make sure we're making money. Nobody wants to work for free. Okay, I'm actually going to pop a live poll into the chat, and we'll keep the system open for a while so that you can go ahead and answer these questions to see, did you gain the information from today's session to make sure that you understood what we have? Please don't worry about it. If you didn't get it right, we still want to know, did you gain it? Or do we need to shift the way we teach something to you? So that's very important to us to make sure that we're actually assisting you and covering the information that you would want. I'm going to keep the debtors aging file and how it ages for a latest, well, let's see if we can cover it in 2 minutes. Let's see. So a debtors aging then goes and says, what does our aging buckets look like? So if you were to imagine this in an Excel spreadsheet, you would have customers that have invoices that are due now, current, because they were invoiced. If we're talking about from statement, the statement was sent 2 months ago. So it was sent at the end of, where are we now? It would have been February, and they're coming to be due at the end of March. Therefore, they would be current. If they were sent at the end of January, they were due at the end of February, but they actually then rolled over. We would start looking at our different aging buckets. So you can see that we have different aging buckets. Current, meaning it is currently due. 1 to 30 days over when it was due. So 1 to 30 days means that the invoice was due, and we are now 1 day over. So if today is the 1st of the month after it was due, and up until the end of the month, that bucket, we call it 30 days overdue. And or if it is 60 days overdue, means that there was the due date and we are now 60 days or 2 months late. So that is what we call the aging of the debtor, how they move from one bucket into the next bucket of overdue. So the 30 days means 30 days after it was due, not 30 days since we sent the statement. So that is what we do in terms of what we call an aging file or a debtor's aging file. And this tells us, there's a whole bunch of things that we talk about when it comes to the aging file. Is how are we going to collect these funds? We want to make sure that if we are not going to collect these funds, that we need to make sure that we have our expected credit losses, which is what we spoke about last week, to make sure that we are accounting for the fact that we may not collect these funds. And or do we want to take legal action? Do we want to take a judgment? Do we want to hand them over to a specific company? What do we do if these customers age further than 90 days plus 120 days plus? What are we going to do about it? So this is how our credit team tracks payments and makes sure that our collections are within the range that we're allowed. And if somebody does move into the 1 to 30 days overdue, are we going to charge them a penalty. And what's the penalty fee for this? What's the penalty fee for that? What's the penalty fee for this? And do they keep accumulating over time? So this is what a debtor's aging looks like. Again, if you have different terms, for example, if you've offered 7-day terms, you would have a rolling bucket that went 7, 14, 21, 28. So it would roll according to the terms you have provided. So very important to know that the terms are based, and the aging bucket is based on the terms you have given. So if it's 3-day terms, it will go 3. If they haven't paid on 3, then they go into the overdue amount, which would be 3-day bucket, the 6-day bucket, the 9-day bucket, and they would then roll like that, meaning that they are overdue. So one of the things that TradeShield does is we look at protracted default. What's the likelihood of this customer not paying you within terms? And if they exceed it by 90 days, we would then consider that a default if it has not been paid within 90 days. So very important. This is how we track the debtors aging. I do understand that we are now 1 minute over time, so we'll hang on to the call for any questions or comments. Of course, we will post this information for you on our Knowledge Center. We will post the slides there for you, but we are always here to support you as a team. So please reach out to us. And as I said, this is a 4-part series. This is number 1 within the credit environment, and we'll see you for the next 3. You can re-register. You can register for those now. It was part of the email that we sent. So if you want to hear more, please join us again. If you have joined us for the first time, thank you so much, and we wish you a wonderful day.
Excellent.
Thanks, guys.
Thank you.
Thank you.
Thank you. Bye.
Thank you.
Thank you. Yes, Vanessa, I see you have a question. Vanessa?
You're on mute.
Can you hear me now?
Yes, we can.
Yes.
Morning. Hi, everyone. Just wanted to say thank you, Amy, also for the informative session. It was very, very nice to hear details that you might have forgotten, that you think you know, still in your head somewhere. It's in the archive, but now it's fresh in the memories again.
Thank you. Thank you so much, Vanessa. We're so happy that you gained some information from us. And as Martin said, we hope you learn, even if it's just one thing.
Super. Keep well, everyone.
Thanks so much. Bye. Aliane.
Me unmute myself too. I wanted to just ask, is there a common response you can give debtors that sign terms of trade with you, but when it comes to payment, they say, well, our terms are 45 days from date of sale, or whatever, different to what they originally signed with you? Is there like a quick response or a general response you can give to them? Because it is a long drawn out process to actually,
Yes, absolutely. Especially in your industry, which you are like majority of the spend of somebody's construction. So I definitely understand that. So Martin, I'm going to leave this one to you to say, what do we do if somebody suddenly wants to change their terms?
Well, and it's actually a very sensitive state to be in. That's why I'm always so very adamant about it, that we upfront understand our clients' process that will determine the term that they're going to pay us. Because now you probably price them on a 30-day term. 45 days, I mean, it's 15 days longer, but the volumes and the size of the tanks and the cost of the tanks and all of that's going to have a huge influence on how you're going to get paid and how quickly you're going to get paid. Because it's going to affect your cash flow. Because you might make commitments because of your expectation, and now you can't meet your commitments because your expectation the only thing that I would suggest is that you say, guys, we got to then adjust our pricing the next time, because to accommodate you on a 45-day term is a different pricing schedule. And we can maybe accommodate you this one time, but if you place another order with us, the tank's not going to be 45,000, it's going to be
Mm.
47,000
Mm.
because we're going to have to bear that cost for that longer period that you're going to take to pay us.
Right.
But there's no golden rule. It depends on who you are, what you trade in, and then, of course, the most important part is how strict is your business going to be on applying the rules of engagement. That rules that you've set out in your credit policy. Is your company going to be as strict as what I've just said? Or are they going to say, these guys have been buying from us, or they're a good company, or they're not going to take us.
Mm.
It all
Or
depends.
not.
Yeah.
But
Yeah. We
that,
we do
that's my advice.
negotiate a lot, but not when terms are changed mid-project. It just makes
No,
it ridiculous.
Absolutely. I think that
Right,
what
mine-
you're asking as well is from a standard response to say is here's the terms and conditions that you signed, which is a legal binding contract. And this is the lecture standard that we did negotiate that. If you'd like to renegotiate, then we'd have to go and do the process again in terms of I'm going to reassess you on the new terms. I may potentially give you new pricing. And that is up to your company policy to say this is what we're going to do. And you can add this to your policy to say if this happens, we're going to A, send you the terms and conditions. B, we're going to renegotiate our pricing, and C, we're going to have to do this check again to see that you're actually eligible for the time you've asked.
Okay.
Or if you've got an interest clause in your terms and conditions,
We
then
do.
you say, no, that's fine. If you pay 45 days, but your terms are 30 days, we're going to add 15 days interest onto your account at this rate. This is how
Right.
much calculate it and say, it's fine, you can pay us in 45 days, but we're going to charge you 15 days interest. This is the interest. you're
Okay,
charging.
that's a yeah.
That
that's
might
a good
just
idea.
change very quickly.
Yeah. Yeah. Okay, thank you.
If that helps you. But of course, you can always reach out to us with individual cases, Leanne, to say like, what do we do here? And we can advise you with absolute pleasure.
Will do. Thanks, Amy.
Excellent.
Thanks, Martin. Appreciate it.
Thanks, Leanne. So we're going to hang on just for a little bit for those that are still completing the survey or the poll or the exam questions, should we want to call it. So we can hang on for a little bit.
Where can we get the results? I think I closed mine before I looked at my answers.
Oh, okay. I can send it to you afterwards, Leanne, with pleasure.
Thank you.
Okay.
Amy, it's Mari speaking.
Hi, Mari.
Hi. Pumeza didn't get a questionnaire.
Oh, okay.
Hers didn't pop up.
Didn't pop up. If she goes to the chat, is she online with us?
Yeah.
Okay. If she goes to the chat function, then in the chat function, she should see the poll there and be able to complete it.
Okay.
From the chat.
Did you hear? Oh, she already left. Sorry. Okay.
Okay. She can rejoin if she wants, and then it will be in the chat function. Okay.
Okay. Okay. Thank you.
No problem, Mari. They do things differently in Secunda. No, I'm joking.
Also, sorry, Martin, you mentioned something about Rustenburg Platinum Mine. Was it a closure?
No, it's just, I could use it as an example.
Oh.
It's not going anywhere.
Just an example. A real example now is the possibility that Mittal Steel in Vanderbijl Park could have closed. I see the government has now jumped in there and said, they want to try and rescue the business and stuff like that. In my mind, it will still leave me with a lot of questions because if Mittal Steel in Vanderbijl Park closes, if you think about it, there is Air Liquide that's got a business right next door. There is Afrox Gas that we've got one on the other side of them. Why they are probably one of the most critical suppliers to them. So those two branches, although they supply LPG